Can you have multiple retirement accounts? Can you have a 401k at work, a traditional IRA, and a Roth IRA all at the same time? Or maybe you have 3 old 401k's sitting around from past employers, and you're wondering if you're breaking some secret IRS rule. Listen to me. The short answer is yes. You can have as many retirement accounts as your heart desires. The Internal Revenue Service does not care if you have 2 accounts or 20. But here is the catch, and this is where so many people heading into retirement make a massive, costly mistake. While you can have multiple accounts, you do not get multiple contribution limits. Let's talk about the real problem. The problem isn't how many accounts you can have. The problem is the sheer financial chaos and paralyzing fear that comes with spreading your life savings across a financial graveyard of forgotten accounts. I know what you're feeling. You're approaching retirement, or you're already there, and you are terrified of running out of money. You're afraid that if you look too closely at all those different accounts, you'll realize you don't have enough. Or maybe you're afraid of making a mistake with the IRS and triggering a massive tax penalty. So what do? You do nothing. You leave an old 401k with an employer you left a decade ago. You have a traditional IRA at one bank and a Roth IRA at a different brokerage. You think you're diversifying, but my friends, you are not diversifying. You are just making yourself disorganized. When your money is scattered all over the place, how do you know what your true asset allocation is? How do you know if you are taking too much risk right at the moment you cannot afford to take losses? You don't. You are flying blind. Let's get clear on the rules, because knowledge is your ultimate power against financial anxiety. First, let's talk about IRAs, individual retirement accounts. You can open a traditional IRA and a Roth IRA. You can open 5 of them if you want. But the IRS says that your total, combined contribution across all IRAs cannot exceed the annual limit. If you are age 50 or older, you get to make a catch-up contribution. You can put in up to $8,600 total across all your IRAs. If you put $5,000 into a traditional IRA, you can only put $3,600 into a Roth IRA. If you contribute the maximum to one account and then contribute to another, you have made an excess contribution, and the IRS will hit you with a 6% penalty every single year until you fix it. The same applies to workplace accounts like 401k's or 403b's. If you work 2 jobs, or if you work a corporate job and do some consulting on the side with a solo 401k, your total employee contribution limit across all those workplace accounts is capped. If you are age 50 or older, that limit is $32,500. If you are between the ages of 60 and 63, thanks to the Secure 2.0 Act, you have an even higher enhanced catch-up limit of $35,750. But that is your total limit. Opening a second 401k does not give you another $32,500 of contribution room. Now, why does having all these accounts become a nightmare when you retire? It comes down to 2 major issues: fees and required minimum distributions, or RMDs. Every single retirement account you own has administrative fees, management fees, or mutual fund expense ratios. When your money is fragmented into small chunks across 4 or 5 accounts, those fees eat away at your principal like termites in a house. You think it's just a few dollars here and there, but over a retirement that could last 30 years, those hidden fees can strip tens of thousands of dollars right out of your pocket. Then comes the real monster, RMDs. Once you reach age 73 or 75, depending on your birth year, the IRS forces you to start taking money out of your traditional tax-deferred accounts because they want their tax money. If you have 5 different traditional IRAs and 3 old 401k's, you have to calculate the RMD for each specific account or ensure the total aggregate RMD is correctly taken from the proper accounts according to strict IRS rules. If you miscalculate, or if you completely forget about that old 401k from a company that changed its name 15 years ago, the penalty is brutal. The IRS will charge you an excise tax on the amount you were supposed to withdraw but didn't. Why would you subject yourself to that kind of stress during what are supposed to be your golden years? So, what is your actionable takeaway today? It is time for financial spring cleaning. It is time to consolidate. I want you to sit down this weekend and gather every single retirement account statement you have. Look at them. If you have old 401k plans sitting with old employers, you need to execute a direct rollover. You want to move those old 401k's into a single traditional IRA or, if it makes sense for your tax bracket, convert them into a Roth IRA. By doing a direct custodian-to-custodian rollover, the money moves straight from your old plan provider to your new IRA custodian. The check never touches your hands, which means there are zero tax consequences and zero withholding penalties when you consolidate your traditional accounts into one traditional IRA and your Roth accounts into one Roth IRA. Magic happens. Suddenly, you have total clarity. You can look at one dashboard and see exactly how your money is invested. You can rebalance your portfolio with one phone call or a few clicks of a button. You can manage your income streams and your future RMDs with ease. Most importantly, you reduce your fees and you put yourself in the driver's seat of your financial future. There are only a few specific reasons to keep multiple accounts. For instance, if you are currently employed and getting an employer match on your 401k, you absolutely keep that account active to get that free money. If you want to keep a traditional IRA for tax-deferred growth and a Roth IRA for tax-free withdrawals to pass on to your children, that is smart tax diversification. But keeping old, dead accounts active out of laziness or fear? That is a luxury you cannot afford. Do not let complexity paralyze you. You have worked too hard and saved too long to let disorganization threaten your security. Consolidate your accounts, take control of your fees, and give yourself the peace of mind you deserve for your retirement. You can do this.